Welcome to part 3. So this video we are proceeding with lastly we stopped at interest rate future, so we are going to start from interest rate future onwards. So interest rate future is you have to first write the statement whether you are going to sell or buy future and what future, right? So if it's a borrowing, then you have to what? Sell future. And if it's a payment, you have to buy, right? So here you have to sell the future, and as the borrowing is required on 1st May, June contracts are needed. So you need June contract if for a borrowing on 1st May. Now you here also you have to calculate number of contracts for options and for future. So you have to, it's a borrowing of 22 million, contract size was this, and it is for 5 months, but the contract size of future is always 3 months. So it is 36.67, but you have to take 37 contracts. Now the basis, coming to the basis number 2. First is contract, number of contracts. Number 2 is basis. Basis is current minus future. So current price, when you have to get, you cannot deal in terms of interest rate, because your future price is interest rate. You have to, if you are dealing in terms of percentage, then even your future price you need to change it to percentage wise. But since we are dealing in terms of price, here we are keeping it in front. That means the LIBOR, which is 3.3, so 100 minus that minus this future, opening future, this is your basis. Out of that, 2 over 6 is unexpired basis, so which is 0.18. Now coming to interest increase or decrease, same. This question is also about interest increase or decrease. As you can see, you need to calculate cost of borrowing, the expected future price is, yeah, and the gain or loss on the future market, and the net cost, and the finally the effective interest rate. So this, right? So the cost of borrowing will be the interest after increasing and plus 80 basis point into 5 over 12, because duration, it is for 5 months the borrowing, and into the amount of borrowing, which is 22 million. Same for this, but here it is 2.8 in terms of 3.8. You can keep it one after the other, increase or decrease, or line by line like this if you have space. So expected future price, now you have to find the closing future price. So closing future price is 100 minus this one. Don't add 0.8 with that, just 3.8 minus 0.18, because your unexpired basis is 0.18. Same for here, and you're getting 96 and 97.02, gain or loss, right? So this is not 9,616. This is 96.16, and this is 96.02, right? Into 25 into 37, because 37 contrast, 25 you have to hedge. So this is your loss. Is it a loss? And gain. I'm sorry. This is a gain. That's why it is deducted. I'm sorry, because with loss we always denote by negative bracket, but this is a gain. That's why you're deducting, and this is cost of borrowing. So from this cost of borrowing, you're deducting your gain, and if it's a loss, always add loss with your borrowings. So you're getting the net cost. This, if you want to get in terms of effective interest rate, this is the formula. Learn it. It's fixed. That amount into 12 over 5. Divide this by 22 million, because 22 million is the total amount. Out of that, 12 over 5. Reciprocal of this. Usually it's 5 over 12, but you do reciprocal when from the amount, from the money terms you have to find in terms of interest, you have to use the reciprocal. If from here interest to money terms you want to find out, then it will be 5 over 12 only. Okay. And here the difference in interest rate comes from rounding of the contract. That means this and this should be same, but there's a difference because of rounding, because if we have rounded up the contracts. Now coming to option on future. So option on future I'm not going to discuss, I've already explained. So now let's go to 41. So 41 we have covered. Now going to starting with 42, right? If you see 42 here, same question. Interbank less 20 basis point, you invest fund at this LIBOR minus 20 basis point, similar. And this is the rate, right? Increase or decrease by this amount, so it is same. And if you can see here, we have future. Future I'm not going to cover, I have already covered. We have option. Option I'm not going to cover, already I have covered. What I'm going to cover is FRA. This I haven't covered before. That's why I have selected this question. So I am only going to do FR. FR is in fact the easiest one. Even in exchange, even in interest rate. So the question says to choose the hedging strategy for that 48 million investment. Okay, and part B, if you see, a member of Treasury Department suggests that option contracts are purchased to hedge against interest rate movement. The number of contracts should be determined by hedge ratio. So here they're talking about hedge ratio based on delta value, right? So know this, what is this hedge ratio, what is this delta value and all, right? It's not very big, it's very brief. Just briefly you have to know because it's for 6 marks. So coming to this FRA, now FRA you have to choose a rate. Your FRS will be denoted like this, by the way, 1 to 7, 3 over 4, it could be anything, and some rates will be there. You have to choose one rate, right? How do you choose that rate? How do you choose that rate? Since I don't have the full question, so I cannot tell you the terms, but let's go to the answer and see. FRA. They have taken 4.82% FRA, which is 3 to 7. Now, they have given you the reason why it is like that. Since the investment will take place in 3 months' time for a period of 4 months, understand this, what it means. Okay, so when an investment will take in 3 months' time means this is your starting. Your starting will be 3 because 3 months of 4 months. Okay, for a period of 4, wait, let me highlight it. Wait. Okay, so for a period of 4 months means not 4, not 3 is to 4. Add 4 with 3. Starting point is 3. You have to determine your starting point. Once your starting point you write it correctly, then there's very less chance that you are going to miss out on the next one. So 3 plus 4 is 7. That's why here if you see it is 7. If I'm giving you another scenario for you to explain this, if they tell that investment or borrowing, let's say it will take place in 4 months time for a period of let's say 6 months. 6 months. How are you going to write it? How this FRA rates will be right? 4 months, starting in 4 months for period of 6 months. It will start like this. 4 FRA, right? Add 6 with this, it will be 10. Understood? That period of 6 months you are adding with 4. Starting in 4 months time. So with the starting you are adding the period. That's how you get the FRA. Now once you get the FRA, here also FRA rate increases, FRA rate decreases. So first we are going to work on the increasing part. Increasing part, now we got the percentage. What is it? 4.79. How did we get 4.79? Here if you see, you are investing at what? 4.0 minus 20 plus 0.9. That's how you are getting it. 4.79. So make sure this rate, you know how you got it. Right? You are 4.09. I'm writing here. 4.09 minus 0. What is the basis point? I forgot the basis point. 20. So 0.2 plus 0.9. Right? So that's how you are getting 4.79 into 4 over 12 because it is for 4 months. And this is the amount of payment. Sorry, yeah, it's a receipt. Then next comes is who pays to whom? Key area. FRA does not come very frequently, right? Maybe two or three times, but it is one of the simplest thing. If it comes, you are very lucky. So where do I start? Yes. Here they are saying payment to the bank, but how do you know whether it's a payment to the bank or not? It is very simple. This is a payment or a receipt. It's a receipt. It's a receipt. In terms of receipt, when your interest rate increases, okay, when I'm writing interest rate increases by showing an arrow, but you write full sentences so that you understand if you're not understanding the short form. So receipt, when interest increases, what happens? You have to pay to bank. Why? You are getting more interest. You are earning more interest than which is there in your FRA rate. That's why you have to pay the difference. Think logically. It's a receipt. Likewise, you have to be able to make the four solutions for four things. What happens when for receipt when interest rate increase or decrease? What happens for payment when interest rate increase or decrease? So this is for receipt. When interest rate increases, you are earning more interest than which is allowed in FRA. So you have to pay that extra, that difference to the bank. When is the other way around? In receipt, your interest rate is going down. Bank will pay you. They will compensate you for that reduction in interest rate if it goes below FRA, because ultimately it will be fixed at this rate. Look at your FRA. FRA is 4.82 minus 20 basis point. So it will be 4.62 only. It will be fixed at this rate. If it increases, you pay the bank. If it decreases, bank will pay you. Now let's think for that from the perspective of a payment, borrowing. For borrowing when interest rate increases, bank will pay you. When interest rate decrease, you have to pay to the bank. Okay, you can write it while I'm saying. You can even pause my video, go back if you are like I'm going too fast. Okay, so 4.99 minus 4.82, the difference is now your interest rate is 4.99 but FR is 4.82. The difference into 48 million for 4 months is your payment you have to pay to the bank, so deduct it. Same way for deduction also, everything else is same. The difference is this time it's a receipt. Bank is going to pay you. Bank is going to pay you the difference because interest rate is decreasing. You are having a loss, right? So if you see here futures and then all these things, all this, if you can see basis point, closing future price, everything is same. So I'm not going to go in detail on that. Let us go to 43, right? So 43, if you can see here, we have interest rate future, we have interest rate future, we have option on interest rate, right? So here, this situation is little different. Here, it increases by 1.1% or fall up to 0.6%. The rate is different. Earlier we saw increase or decrease was 0.5%. Here it is different, right? But under both you have to show. So if you see here, everything else is MC 4, 9, 5, 10. You have to select out of this two which one it is. So that you have to select, and if you see option, you have to select. So everything else is same. Here if you see part A, you just have to hedge. Now part B is asking a theory question whether you have whether it is better to have a separate treasury function or a single global treasury function. You have to give points about each one. Treasury function is very important thing. Make sure that you learn about treasury function. Now I'm going to 44. Just check out the question on 44. Right? I'm not going to go through this. Reading requirements is enough. So based on two hedging, you have to say which one is the best. That's part A. Right? Which one is the best means what? In terms of options and what is it? Swap. And part B, if you see part B and C, these are theory questions. Centralize. How centralized treasury will increase the value, and also the possible reasons for the. So this I'm highlighting it, right? So centralized treasury and decentralized treasury department, key area in the theory part. Next, part C does not come very frequently. Islamic finance, but at least very briefly just read it once or twice. Okay, so explain the key difference between salam contract using Islamic finance. You shall be able to give the differences. Usually this is the question which they give. If they give Islamic finance, they usually tell you to give the differences between that Islamic finance product and the normal derivatives like futures or options. Compare it with salam or mudaraba or mushraka contract, like that. So that only that much is asked, right? So 45, if you see 45 has a little bit different, right? So we have done with 44, coming to 45. 45 here, what you have to do is here mark to market. That's why I brought this question here to your key area. You can be asked questions. This I'm not going to cover all this this thing, right? Option, future, and so on, and all those blah blah. My focus is on this part, to do mark to market, how to do it, right? Because it comes in part B. So if this question comes like this, you have to find a gain or a loss. I'm sure you know how to do mark to market. So let us do 45. If you see here, my concern is in part B. So now, starting when market to market, you have to start by date. You have to start in a chronological order. So first is 2nd June. So starting with 2nd June, if you see here, 2nd June it is 95.76. So 95.76 minus 95.84, right? The difference into 25 into 50 contrast. 50 contrast previously we have got it, and 25 you have to hedge. So it's a loss or a gain. You will know whether it's a gain or a loss depending on whether it's an option to sell. You are selling the future or buying the future. Okay, so to know that, let us go to 45. Okay, so the question asks 50 bought at this date and 30 future was sold on 3rd June, 95.61. So on 3rd June they are selling it. So before going to 3rd June, 2nd June, that means we are buying. So we are starting opening means every day you buy, you close. On the first day, opening day you buy, and closing day you sell. So you're buying at 95.84, but you're selling at 95.76. You're selling at a lower rate. That's why you're making a loss of 10,000. Now on 3rd June when you come, you have to pay a little, okay, be critical. So here it is the 95.66 minus 95.76, right? Why 95.66? It is the next one, this minus this, and you're selling it for 95.61. So how they are dealing it here? So 95.66 on the 4th day, the 3rd day minus the 2nd day into 25 into 50 plus 5 basis point. How they got 5 basis point? 95.61 plus 95.66. You are selling it for 95.61, but in the closing day you have 95.66. So that's why you are adding that. This is also a loss. This is also a loss. Total is a loss, right? Alternatively, how it can be calculated is there. You can go and check. So coming to the last one. Last one is the last one's date minus one before that, the previous one, right? Here it's a profit because you are buying at a lower rate and selling at 95.7 at a higher rate. That's why it's a profit. So now, how are you going to deal with this? As you can see, 2nd June 10,000 loss, 3rd June 16,250. That means total 17,250 losses there plus 4,000 profit. So if you add 17,250 with 4,000, that means it will be 13,250. to 50 loss, right? Whether you have to do anything or not, whether you have to pay a payment margin or not, will be there in the question. What is the maintenance margin and all. So now we can go to 46. 46 is kind of different. As you can see here, we have some annual forward rate for the year 2, 3 and 4 as follows. So some rate has been there, and you have been given some yield curve rate. So let us do this. 46, right? This question also comes at times. How much the company should expect to pay or receive every year on the swap, excluding the fee of 20 basis point. Explain why fixed annual rate is this one is less. And here disadvantages and advantages of swap, that you shall be able to do it. I'm not going to focus on it. And last is, it is about some floating rate debt, right? Equity capital to pay up the floating rate debt. That also you shall be able to do it. So coming to my one is part A and second part, first part of B. Demonstrate how their interest payment liability does not change after it has undertaken the swap, whether the interest rate increase or decrease. So 46, how are you going to do it? This is fixed, this method from your textbook. That's why I'm taking you through this, you need to know. Right? So this already I've explained how it is. So make sure that you watch my video on question 46. Okay? So I've explained all this. How this is fixed. It is there. And so these are all your receipt. Then you have to take your payment. Once you take your receipt minus payment, this will be your net payment or receipt. So this is the working steps. Right? And then you need to write this. Why it is lower and all. Then we are going to 47. If you see 47 here. Just read 47. Part A part. 46 and 47 are similar. Just see the question. I'm not reading it in front of you. You can read it by yourself. We have to estimate the forward rate using current annual rate. Right? And also this are some key areas on swap, as you can see. Now we'll go and see 47. So when you get a question on 47, starting point is like this. Same how you have done for 46. These are your what? Receipt. This is how you have to take your receipt. This is your payment. So deduct your receipt from payment. Right? And how you got these rates. Right? This, and this. This is the fixed method. You have to know this method. I've explained you previously. So please go and check how I got the numbers. Number part I'm not going to explain, but this is the method. And it's a fixed. It will not change. This is the method only. Next. So take all your receipt, deduct your payment, and you will get payment of receipt. And then comes to your interest payment liability. Right? This. What is it? 47. Let me go to 47. Okay. So here is the yield curve at 4.5 and 2.9. You have to show the payment. That's why they have taken 2.9% and 4.5. At what? At that what happens? Right? So make sure that this also you have covered in my video, which I have previously explained. Now let us go to for 50. From 50 onwards till whatever question here it is, 56. This all are theory questions. Right? It is all theory questions. I'm sorry, it's in a 50 marks question. That means it is combined with net present value. So let us go to 50 and see. Right. Okay, so starting with 50, if you can see here, you have been given some current spot rates and you have been given some rates for each year because the project is for 4 years, and you have been the inflation also. So based on the inflation, you have to take purchasing power parity, you have to predict. That's it for this 50 mark. How it is done, we'll show you. Just check here. So sometimes this is an exchange rate, right? Or this one. If the currencies are different, then it would be different. That's why two lines of exchange rates are given to you. Here you have to convert to this currency if it's not in AFM. Next. So here, that's it, right? Just 120, everything is given here, all these rates. So here, since the rates are given, you can just use these rates. You don't have to use inflation rate. Coming to 52. Do I have a solution for 52? Yes, 52. So 52. If you see 52 also, just here, very slightly it is used. This one. That means for each year. This is currently they have given. Each year you have to predict. How will you predict? You have your inflation? Yes. Now I will take you through 52. Just see. So this cash flows are in other currency, foreign currencies. Now using that, this exchange rates. You have to, first have to predict this exchange rates, and using it you are converting it to dollar. So this is the use of exchange rates. Up to here, that's it. You are not doing any hedging or anything. When it's given as a 50 mark question with net present value. Right? And how exchange rate has been given, calculated is given here. So it is 72 from here, which is year 0. Starting from here, this is the inflation rate, 8% and 2%. So you are using the inflation rate of the two country. So this will become here, then on this you put inflation, and then it will become there, like this. Next 53. So 53 question is, here if you can see again here, see, again this was repeated somewhere, centralized and decentralized, own individual treasury department or not. Which one is better? Here, one thing which I want to tell you here is, see, usually when we give conclusion, we don't give an exact conclusion saying that you have to choose this. We give advantages and disadvantages, and then we leave it to the board that based on their risk preference or whatever they want, the choice is this. So that's how we give conclusion. But for certain type of question, you have to give an exact figure, which amount you are going to choose, which hedging method you have to choose. Now, why is it so important? The reason is, just read this question. Estimate the expected amount of Japanese yen receivable under each hedge choice and the additional debt finance needed to fund the project for the preferred hedge choice. Based on that preferred hedge choice only, you can decide your debt finance. So in this type of situation where your hedging amount is needed for something else, based on that maybe additional finance is required. There you have to select one, the best one. In terms of receipt, the highest receipt. In terms of payment, the lowest payment. Okay. So because of that, we'll go to 53. Here, if you see under forward, it is this. Under future, it is this. An option, it is 97, even less. So the best one is what? Future. Future gives you the highest receipt, and therefore it will be used to hedge the expected euro receipt, because you need this amount later. Where is it? 10064. Right? As you can see here, receipt invested. You are going to receive invested later. The amount which you are going to hedge. There you need to select one. Coming to 54. So 54 is also same. You have been given the current inflation based on the inflation rate of the two countries. That is called purchasing power parity predict for the following year, because this is a project. Right? Another key, another theory question which is asked here is, it is in part C. Let me highlight part C. I can actually highlight the whole thing. Why? Learn this. Learn part C, because it talks about risk diversification, right? Whether risk diversification can be achievable by diversifying more for well diversified shareholders. So now coming to 55 or 56. 56, if you see here, you have each in different part. Sale of equity, sale of equity investment in one part, and all this. As you can see, we have forward, that is we have to use forward. We have been given future, we have been given option, that means we have to use all this, right? And dividend history, this comes in your part A, section A, which we are not going to cover in this part, right? So here the older thing is this one and this one is relevant. Here you have to choose an appropriate hedging strategy. Part A, this is a theory question. With reference to purchasing power parity, explain how exchange rate fluctuates may lead to economic exposure. So you have to understand what is purchasing power parity, that concept. So 6 marks. Now coming to mock section. This is the last paper which I'm going to take you through, just to show you how a question might come. Just see here. This is from a mock paper. I think the Kaplan students might not have it, but the BPP students will have this. So this is a very good question, because it covers forward, it covers money market, it covers future. So this is a very quick question. Just see how it is. Just see the standard. Everything is same. Contract size, June, future, September, even for money market, right? 3 month, 2 month forward you have to pick. But one thing, before using all this, make sure that you use internal hedging for this and this. How are you going to use internal hedging? If it's in same currency, you cannot hedge a 2 months for 3 months. 2 months will be 2 months. This is the 2 months payment. But here you can hedge. For France, you can hedge. For Germany, you can hedge the 3 month. You can deduct your payments from your receipt. You're not hedging each and everything. That's why you have different rates for each. You'll see question 2 properly. And also you have this money to market. You have been given the initial margin. You have been given the variation margin. So make sure that you know how to show the impact on it. And finally part C, where advantages and disadvantages of forward and future. Compare both. So that's it for section E of your syllabus risk management, I have covered treasury management, treasury departments, centralized, decentralized, whether it has to work as operating profit center, cost center, or whether specialized staff are needed or not, or any unskilled people can do it. So this type of questions, and then exchange risk management, interest rate risk management. Make sure you know collars, swap, option, future, forward, everything, and also with their advantages and disadvantages. And also you should know using interest rate or the exchange inflation rate of the between the two countries to predict the forward rate, because you need it for your international net present value to convert your cash flows. So that's it for your exchange rate risk management. This is all you need to pass this section. Next, I'll be coming with section reconstructions and reorganizations, which is section D, because that is an area where most of the students are struggling and I get requests to make videos on that area. Thank you and take care.